There are rules in finance, unwritten but sacred. When stocks crash, you buy gold. When banks fail, you buy silver. These are the safe havens, the bunkers, the assets that are supposed to hold their value when everything else burns. But on January 30th, 2026, the rulebook didn't just break, it incinerated. In just 36 hours, $7 trillion in global wealth evaporated. Not from meme stocks, not from crypto casinos, but from the very assets designed to protect us. This is the story of the fastest liquidity shock since 2008. And what it means for your money. I'm Marcus, and this is the breakdown you won't get anywhere else. To understand how the impossible happened, we need to walk through the timeline. The setup, January 26th through 29th. The market wasn't exactly calm heading into this. U.S. Treasury yields had been creeping higher for weeks. The 10-year was pushing levels that made Wall Street nervous. Liquidity, the lifeblood of markets, was already getting tight. Think of it like oxygen getting thin at high altitude. You can still breathe, but every movement takes more effort. The trigger, January 30th, 11:47 a.m. Eastern Time. Metropolitan Capital Bank and Trust, a regional bank with over $180 billion in assets, fails. Not slowly, not with warning, it just collapsed. Now, historically, this is when gold goes supernova. Bank failure equals currency fear equals precious metals rally. That's the playbook. The twist. Gold didn't rally. It crashed. From roughly $5,600 per ounce down to $5,100 in hours. A 9% free fall. Silver, even worse. Depending on which contract you're tracking, silver plunged between 11 and 27%, from around $121 per ounce to as low as $88 in some markets. When you add up global precious metals positions, ETFs, mining stocks, and derivatives, $7 trillion in value, gone. And it all happened before most people even realized a bank had failed. So here's the trillion-dollar question. If everyone was terrified, why did they sell the safety assets? Logic says, bank fails, fear rises, buy gold. Reality was, bank fails, cash vanishes, sell everything. Let me explain the mechanism that destroyed $7 trillion, the liquidity black hole. Imagine you're a hedge fund. You've got positions across hundreds of assets. Stocks, bonds, commodities, derivatives. Your portfolio is leveraged, meaning you've borrowed money to amplify your bets. Metropolitan fails. Suddenly, your positions tied to the banking sector crater. Your lenders get nervous. They make a margin call. They want their money back. Now, not tomorrow. Now. But here's the problem. You can't sell your losing positions. Nobody wants them. Your bonds, illiquid. Your bank stocks, worthless. Your real estate takes months. The only things you can sell are the things people actually want to buy. The liquid assets, gold, silver. Your winners become your sacrifice. Now multiply this across thousands of funds, globally, all hitting the sell button simultaneously. That's not a market, that's a stampede. But the margin calls were just pillar one. There were two others. Pillar two, China's economic data. The same week, China released manufacturing numbers that missed expectations badly. Industrial production, weak. This matters because silver isn't just a safe haven, it's an industrial metal. Solar panels, electronics, batteries. If China's economy is slowing, silver demand craters. So now you've got forced selling from margin calls and demand destruction from fundamentals. Pillar 3, political chaos. January 31st was the deadline for U.S. government funding. Shutdown fears were real. When government shutdowns loom, capital freezes. Nobody wants to be caught holding assets if the system seizes up. And here's the wrecking ball, the U.S. dollar. The DXY, the dollar index, spiked violently. When the dollar surges, everything priced in dollars gets crushed. Gold, silver, commodities, all smashed. Three forces. Same moment. Perfect storm. If this feels familiar, it should. In 2008, during the Lehman Brothers collapse, gold initially fell 30%. Everyone panicked. Safe haven is dead, they said. Then gold rallied over 150% in the next 3 years, reaching all-time highs. Why? Because once the panic selling stopped, the underlying reason people wanted gold, currency debasement, government bailouts, infinite money printing, those reasons intensified. 2026 is following the exact same script, but faster. In 2008, trades took seconds. Now algorithms execute in microseconds. The same dash for cash mechanism, but supercharged by technology. The lesson? In a liquidity crisis, cash is king. Not because cash is valuable, but because it's the only thing that settles debts instantly. The question is, does the rally come next? Or is this time different? We're standing at a crossroads. Two very different futures. Scenario 1, the 2008 playback. The Federal Reserve steps in. Emergency liquidity, rate cuts, bailouts. The banking system stabilizes. Once the forced selling stops, Gold and silver rebound violently as investors realize the government just printed trillions more dollars to save the system. This has happened before, twice in 15 years. Crash, print, rally. Scenario 2, the sovereign debt endgame. But what if this time the printing doesn't work? What if we've reached the point where even government bonds aren't safe? Where treasury yields spike not because the economy is strong, but because creditors are losing faith? Global debt is over $300 trillion. If confidence cracks, there's no asset big enough to hide in. The signal to watch, the dollar. If the DXY keeps surging, everything denominated in dollars gets obliterated. Commodities, emerging markets, even US stocks. But if the DXY peaks and reverses, if the Fed has to start cutting rates to prevent a complete systemic freeze, that's when gold and silver could explode. For the average investor, this volatility is noise if you're holding long-term diversified positions. Don't panic sell. Don't try to trade every spike. Mechanisms that are supposed to prevent crashes, circuit breakers, liquidity facilities, central bank backstops, they didn't stop this. In a true liquidity crisis, correlations go to 1. Everything moves together. Down. 36 hours. $7 trillion. The fastest collapse of safe assets in modern history. What we witnessed wasn't just a market event. It was a stress test of the entire financial system. And the system showed cracks. Here's what I'm watching in the coming weeks. The Federal Reserve's response. Do they hold rates steady or do they panic? Treasury yields. Are we seeing a flight to safety or a flight from government debt? And the dollar. If the DXY reverses, we could see the biggest precious metals rally in a decade. I'll be tracking all of this in next week's breakdown. Subscribe and hit notifications so you don't miss the analysis. The $7 trillion question remains. Was this crash a historic buying opportunity or the first tremor before the real earthquake? I'm Marcus. Stay sharp, stay informed, and remember, in markets like these, knowledge isn't just power, it's survival.